Okay. This is my audience member, King. Begin in 5, 4, 3, 2. Could you use some extra money? Everyone's looking for ways to put a few extra dollars in their pocket. The problem is no one wants to work harder than they already do for their money. How great would it be if you could earn a few extra dollars by simply doing nothing but waiting? Investing in the stock market can turn this dream into a reality. The New York Stock Exchange opened in 1792, which is over 2 centuries ago. Because of this, there's a lot of information out there. There are different opinions and different methods to the madness. The one thing that remains consistent is your terminology. The next important thing in investing is you. It's your money, your investment. These are your hopes and dreams. You should set up your own rules and know your own personal purpose and goals before investing. The very last step to beginning to invest is to take action. I have been interested in stocks and starting a fake portfolio about 2 years ago. It started as a school assignment, and I kept up with the dreams of one day owning my own stock portfolio. Every beginning investor must learn the language of the investment world. Think about it like this. The stock market is a country that you're visiting, and the language is the terminology. Knowing the language when going to the company will help you navigate when visiting. The first word you should know is outstanding shares, which is the total number of shares of a company held by all of its investors. The next word is dividends. Once a company reaches a certain level of sustainability and profitability, it will start paying out dividends, which are sums of money given to all of the shareholders at the end of the earnings period. Earnings per share is the amount of money a company earns per share of its stock. The next word you should know is stockbroker. A stockbroker is a person or company that does the actual buying or selling of your shares on the stock market. When you find a stockbroker, you will open an account with them. This account will hold your money and your investments, whether it be stocks, bonds, or mutual funds. The next word you should know is market capitalization. Market capitalization is the current share price multiplied by all of the outstanding shares. It usually gives the ideal size of a company. You should not equate a company's share price with the value of the company. Comparing market capitalization will give a much better idea of company value. The next word is stock. There are two types, common and preferred. Common stock entitles owners to receive dividends as well as vote on who will be the members of the company's board. Preferred stocks do not have voting rights, but often offer higher claims on assets and earnings than common stocks do. The next word you should know is mutual funds, which are investment programs funded by shareholders and are professionally managed. At the end of the earnings periods, each shareholder will get a percentage of profit from the mutual fund. Bonds are fixed income security that states interest rate and length at the beginning of the investment. At the end of the investment, you will get the percentage agreed upon beforehand, but not a penny more, no matter how good or bad the company does. After terminology, the next important thing is you. You should set rules for yourself and stick to them. There are several rules for beginning investors that most experts agree upon. The first one being to use a set amount of savings. You should use no money that you will need in the next 5 years. If you feel nervous about the money that you have invested, this may lead to irrational decisions, which you do not want when dealing with the stock market. The next thing you want to do is stay away from high risk or individual stocks. Instead, use a low cost mutual fund, which is a collection of stocks and allows you to gain a percentage of the profit at the end of the earnings period. The next thing you should do is do not try to time the market. This is when you try to predict when the market will go up or down and acting accordingly. Instead, you should use dollar cost averaging, which is buying in regular intervals such as monthly. This is a proven method and it will work for you. Research is the next important rule. Knowing your company's future and current plans make it easier to decide on when to buy and sell from the stock. Knowing your own personal goals and purpose in investing is also important. Knowing whether you're in it for a short-term or long-term investment makes it easier to move when the market fluctuates. Once confident enough in your rules and research, you need to decide what path you're going to take, whether it be stocks, bonds, or mutual funds. You need to take action. Don't dwell too long as you lose an opportunity each day. If you feel that you have a company that you can make a quick buck on, take a shot at it. If you're willing to wait long term throughout a bond because you just want a return on investment no matter what the price is, then go for it. The important thing is to be confident in your decision. In conclusion, there are 3 things that beginning investors must do. They must study and know terminology, set rules and goals for yourself, and take well thought ideas and put them into action, even if the action is no action. As Warren Buffett says, investing is a no call strike game. That is, there is no penalty for not swinging. Thank you.